Howdy, friends. Welcome to the program, Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and this is the program called Dollars and Cents for a reason. We help you make sense out of all of those different decisions that have anything and everything to do with your dollars. On the program today, we're going to talk about the 6 things that you need to know before getting a mortgage or refinancing a mortgage. We will also talk a little bit about the continuing conversation about interest rates and how low they are and whether they might turn negative, as has happened already in many parts of the world. And then, of course, we'll have some open lines as well here on the program. The numbers to call in and be a part of the program and add your topic to today's agenda is 407-916-5400 or toll-free 1-866-916-5400. So that's how you can get engaged with us and add your topic into the mix. For the week that was, certainly another week filled with a lot of headlines, as they always are, right? This past week, we heard a lot more about Brexit and the continuing ongoing struggles of the folks over in the UK trying to implement the vote that their folks had about, I think it's almost 3 years ago now, to extricate themselves from the European Union. Still struggling with that. It seemed like they were sort of at least making some progress, had gotten somewhat of a deal on the table, but then their parliament didn't go for it. So that'll be a continuing ongoing story, much as it has been over the course of the past 2 or 3 years. Also, the big news this past week from a financial and market point of view was earnings season sort of really got underway. This is the time of year where companies announce how they did over the course of the past quarter. Usually starts a couple weeks after a quarter ends. And so with the third quarter ending a couple of weeks ago, then now you start to have a whole lot of earnings discussions from all of those publicly traded companies. Going forward, that will continue into next week and the week after. Really starts to kind of ramp up this coming week. So earnings continues to be a main driver of the market. Let's face it, the market is simply a valuation of those companies that are traded on it. And what's the best way to value a company? Well, take a look at how much money it's earning. And this past week, there was a lot of positive earnings. Despite that, the market itself did not move that much. It was basically flat. I think a lot of that was attributable to the performance and the distraction that was Boeing this past week. Boy, on this program, we talk a lot about diversification. We talk about the risk of owning a significant amount of one's portfolio in one stock. And Boeing, once again, gives us another example of the risk involved with that. And you would say, well, Boeing, I mean, they make airplanes. What could possibly go wrong with a company that basically has a worldwide duopoly? I mean, making a commercial airplane is not something that you and I are going to wake up tomorrow and say, hey, you know what? I want to build a commercial jetliner. The costs of getting ramped up on that are significant. That's why there's really only 2 companies worldwide that do it. It's Boeing and it's Airbus. And between those two, an effective global duopoly, if you will, you would say, oh, what could possibly go wrong with owning one of those? The problem, of course, is when there's something happens that's, I guess, rotten in the state of Boeing, and obviously that has to deal with what they were doing from a safety perspective. And so consequently, they really have taken, excuse me, a tremendous hit to their stock price this past week, as you saw text exchanges coming out between some of their test pilots raising concerns over this 737 MAX jet that was responsible for, or was the plane that was involved in a couple of crashes in Africa. And so consequently, as you might well imagine, the market doesn't really take kindly to companies that are cutting corners from a safety perspective, particularly when it involves airplanes. And so on Friday alone, as this story was breaking about the text between, or the correspondence communication between the test pilots, Boeing itself dropped by 7%. Obviously, that contributed a lot to the performance of the Dow, the Boeing being one of the components of the Dow. When you've got one of your 30 companies in that index going down by 7% in a single day, then obviously that's going to really hamper the ability of that index to do much for that particular day. So Boeing once again giving us another example of why it's so important to be diversified. Even though you think, hey, that's a really great company and what could possibly go wrong, the reality is stuff can go wrong, and it can go wrong very, very quickly, which is why in order to reduce your risk from an investment perspective, to own a more diversified investment allocation, meaning it's not solely focused on one company. It's got hundreds, if you will, of companies in the portfolio, so that not one particular, or the developments involving one particular company, sort of fundamentally skew your results. So once again, Boeing being sort of the poster child for why it's important to be diversified and not put all of your assets in one particular company. Make sure you spread it out, and that helps to reduce down the overall risk. Also in the headlines this past week, there was another Democratic debate, and that obviously means that there was a lot of conversation about a wealth tax. And so we thought we would spend some time talking a little bit about what that is and why it's appealing to so many, because when you talk about a wealth tax, the numbers, if you will, that they are looking at in terms of who would be affected, that's obviously a pretty small portion of the population, right? I mean, if you're looking at an extra tax of 2% on those that have assets more than 50 million, I don't know about you, but that doesn't include me. And then the vast majority of people that doesn't include. It's a very small sliver of the population. And similarly, those wealth taxes have a tendency to be progressive. So if you're above 50 million, then it's 2%. If you're above $1 billion, then that's 3%. And so that's how those taxes sort of work, is they look at that total net worth picture of the individual and ultimately determine a extra tax that one should pay based upon the value of their assets. Hence the concept of it being a wealth tax, because it only taxes the wealthy. The issue, though, is that wealth taxes as a whole do not have a particularly good track record in terms of how actually they play out. And you can look no further to Europe as some very good practical examples of what happens when you try and impose a wealth tax. And these numbers are going to kind of surprise you. And it deals with the nature of the assets that people have. And the reality is, when you look at sort of the experience, and you just kind of look at a report out of France that looked at how much they were actually collecting versus how much it was actually costing to enforce the tax. Because let's face it, if you're one of those wealthy few that are getting hit with an additional tax, what are you going to do? You think you're just going to sit there and say, okay, no problem, I'll stroke you the check? Or are you going to hire and call your favorite lawyer CPA combination and say, how do we structure this to minimize this? Well, much like most people do when it comes to taxes in general, that's exactly what happens. And so when you look at why basically all but I think 3 European countries have effectively given up on this wealth tax thing. They all had it and they gave up on it because the cost of enforcing was greater than the revenue that they were actually generating from the tax itself. And the study out of France, these were the numbers. So France raised $4 billion with their wealth tax, but ultimately it was costing them $6.5 billion to impose it. Well, that doesn't make any sense at all, right? And that's why companies like Germany, companies like Sweden, countries like Netherlands, countries like Austria gave up on it, abandoned it. The reality is that the cost of enforcing it was so much greater than the revenue that it was generating that it just, I mean, conceptually it sounds like, oh yeah, well, that, tax those other guys, that small group of maybe several thousand people that have more than 50 million, certainly several hundred that have more than $1 billion. Of course, assuming that they all live in the U.S., which they don't. But the reality is that while that might sound all great, when you stop to think about, okay, well, how do you do it? That's where the problems comes in. And it goes to the very nature of asset valuation. So if you look at the split among the super wealthy of where those assets are, the conspicuous things that we all think of as normal folks, the jets and the yachts and stuff like that, it really only amounts to about 2% of that total net worth picture. Another 5% is in the form of a house or their real estate holdings. And so at the end of the day, yeah, okay, you can probably get pretty good number on that. I mean, shoot, every year, this time of year, if you own property, you're getting your tax bill for your real estate taxes, and that's based upon the value of your house. But the reality is that when you start to then, okay, well, how do I value a plane or how do I value a yacht? Okay, maybe you could come up with that number. But the vast majority of wealth for those super wealthy, 73%, is in the form of public or private equity ownership. That's where the majority of that wealth comes from. And what's the problem with trying to determine the value of a private company? Well, a big problem, because you're never going to be able to come up with a right number on that. And there's a lot of tricks that you can play in terms of who holds what and how it's owned that ultimately reduces down whatever the value is of that private company. So that was really what was happening throughout Europe, is that folks were taking advantage of legal and tax-related strategies to try and reduce down that overall picture. And so consequently, it wasn't raising nearly as much as what was expected because, if you're super wealthy, chances are you've got the name of a lawyer or CPA on speed dial, I'm thinking. And that's what they all did. So great concept, but it's one of those things where the practice of it winds up being much trickier than what it sounds. We'll have some final thoughts on that topic when we get back. We'll take our first break and return here on the program. This is Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando. Welcome, friends, back to the program, Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio WFLA Orlando. On the program, we're talking a little bit about the wealth tax proposals that we're hearing a lot about and the shortcomings associated with them. It sounds like that would be pretty simple and a great way to raise money on those few that have obviously a lot of money. And so asking somebody with $1 billion to say, hey, kick in an extra 3%, conceptually, it makes sense, which is why it's relatively popular if you kind of survey the population. But the reality is that there's some very practical real life experiences by a host of countries, particularly over in Europe, that have all but abandoned that approach because at the end of the day, when they ran the numbers, they realized, wait a minute, we're not generating the revenue that we thought we were going to from this, combined with the cost of actually enforcing it was greater than the revenue range. So countries like France and Germany, Austria, they've all given up on that because, let's face it, the super wealthy, they're not just sticking money in a checking account, right? I mean, they've got assets spread all over the world. Very hard to then come up with what that value is. And more importantly, a lot of that wealth is concentrated in private equity holdings. And that's what makes it even more difficult, is trying to come up with a valuation of what you should be paying. A wealth tax probably wouldn't be a boon to the U.S. Treasury. It would be a boon to the lawyers and accountants and CPAs and those types of folks that would find their services in much greater need. And ultimately, I think that would be more of what you would see. Certainly, that's the experience over in Europe. So certainly, there's got to be a way to generate some revenue. Unfortunately, I think the folks in Washington should be focusing on generating revenue to pay for the debt that they are running up on a regular basis. But sadly, no politician, Democrat or Republican, wants to talk about that stuff. I guess we're just kicking that down for our grandkids to have to deal with. Unfortunately for them, right? Anyway, we'll shift gears and get into one of the topics that we mentioned at the top of the program, which is some of the things that you need to be aware of when you're thinking about getting a mortgage or refinancing your current mortgage. And you're hearing a lot, obviously, about mortgages and refinancings because, once again, we've seen rates sort of come back down to levels that are at incredible historical lows. And so when you're thinking about a mortgage or a refinance, there are really 6 elements that you need to understand. It's not all about the interest rate. I think far too often people look at the interest rate and they say, oh, that looks great, I'm going to do that. And they lose track of the other key elements to be aware of when it comes to a mortgage. And of course, interest rate is important, right? I mean, you don't want to be paying 6% if you can pay 4%. I mean, that is self-evident. But there's a number of other things that you need to be aware of and make sure that you understand what those other elements are in order to make a really informed decision on a mortgage, if you're getting it for the first time, along with whether it makes sense to refinance. So here are the 6 elements. We'll kind of break down each of them and talk a little bit about each of them. The first is term. Term basically is how long is the loan for. Okay, traditional mortgages are either 15-year or 30-year. So on a 30-year mortgage, because it's a longer period of time of payback, there's a little bit more risk associated with that, right? You got 30 years to pay me back. That's a long time. Something might go wrong in that longer time frame versus then, say, a 15-year mortgage. So what happens then is that a 30-year mortgage is going to have a little bit higher interest rate than a 15-year mortgage. Again, that's reflective of the risk involved with having somebody pay you back over 30 years versus 15. Higher risk if you're paying me back over 30 years because something could go wrong during the course of that extra 15 years that's the loan is for. So term, or the length of the repayment, is obviously a factor in determining whether you're getting the best possible mortgage. And so consequently, when you look at the current interest rate on a 30-year fixed, it's 3.92%. That's sort of the average nationwide today, versus a 15-year, which is 3.33%. So you can see where a little bit of a difference, although not a whole lot. Usually there's a little bit bigger spread, but when you have interest rates as low as they are, that spread is really kind of tightening, if you will. So that's the difference in how the term relates to the interest rates. But the other part of the term is then how that calculates out to the payment. So if you look at a $100,000 mortgage, very simple example, and you have a repayment schedule that's 30 years at 3.92%, you're going to have a monthly payment of $473. Meanwhile, on a 15-year mortgage, that is going to be $707. So that's an extra $234 each and every month that you'd have to make to the payment. The reality is you are locked in on that. It's not like you can take a vacation from that. If you've got a 15-year mortgage, then that's the amount that you must pay. So just be aware that if you're trying to kind of minimize your cash flow because you've got other things that you want to do, maybe save for retirement, help pay for a kid's college, the commitment to the 15-year mortgage really is a commitment to a higher payment that does not have the flexibility to pay a lower amount at any point in time during the course of that 15 years. So be aware that one of the things that you look at when you look at term is what ultimately is the payment going to be and how much does that affect my cash flow. Now, the really neat thing that's happening out there is that because of how much interest rates have dropped, many people are finding that they could refinance their 30-year mortgage at, say, 4.5% or 5%, and refinance to a 15-year, and ultimately the payment really doesn't change because you're going from that big of a drop in interest rates. That's a great idea, and one of the things that we encourage people to do is if that is an option that's open to you, why wouldn't you do that? Because you're getting a lower interest rate. You're not changing your cash flow. And at the end of the day, the mortgage is going to get paid off within a 15-year period of time. So besides interest rate, and obviously that's one element, the term or the length of the loan also is pretty important because that helps to determine exactly what the payment is going to be. But there's the four other elements of a mortgage that you also need to be aware of. And we're going to slide to a break here at the bottom of the hour. When we come back, we'll go through those other elements of a mortgage that you need to be aware of in order to make the best decision as to whether a mortgage or a refinance is the right thing for you. So we'll do that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio, WFLA, Orlando. My name is Joel Garris of Nelson Financial Planning. We're talking a little bit on this segment about some of the things that you need to be thinking about when it comes to deciding about a mortgage or perhaps refinancing a mortgage. We talked about the first two, and those are probably the most important two, but there's other parts of the equation that you certainly want to consider when you're looking at refinancing or getting a mortgage. First, of course, is the interest rate, right? I mean, that's what everybody sort of gravitates to, but there's more than just that. You have to look at the term. Should this be a 15-year or a 30-year? What's the difference in cash flow? Can I afford that? Can I afford that commitment? Or, as I mentioned before the break, what we're actually seeing is that a lot of people have the ability to refinance from 30 down to 15 and have it not really make any changes in their payment. That's a great option if that's available to you, and one that we urge people to think about and consider, because if you can go from 30 down to 15, it doesn't cost you anything in terms of payment, and that's simply because of how much interest rates have dropped and how low interest rates are. So certainly something to consider. But there's a lot of four other things in our book that you also want to be thinking about when it comes to refinancing or getting a mortgage. Next up on that list would be what the total loan amount is relative to the value of the property. Why is that important? It's important because that's typically where the bank is going to stick you with private mortgage insurance if there's not enough equity in the house. And generally, banks are looking for about 20% equity in the house. So let's say you buy a $200,000 or $250,000 house. They're looking to have about $50,000 in equity, meaning you're not borrowing the money to come up with that $50,000. Now, obviously, there are exceptions, VA programs, other types of loans that are designed specifically through a combination of loans to avoid that PMI. Bottom line is, the reason that loan to value calculation is so important is, look, the private mortgage insurance isn't insurance for you to help you if you can't make your mortgage payment. That's not what it is. It is solely designed to help the bank if they have to foreclose on you. So you're basically helping the bank offset its liability of giving you the loan when you're paying that private mortgage insurance each and every month. The biggest problem with that is it's like impossible to get rid of. Okay, they make you jump through so many more hoops to get rid of that than they ever used to do. And so it's very difficult to get rid of that, even though the value of your property may have gone up. They still may require you to, well, you still have to pay it for, a 5-year period of time. That's really ridiculous and unfair to the consumer out there who is borrowing that money. The reality is that's why that loan to value, understanding what that is. Okay, how much am I borrowing? What's the value of the house? And making sure that that ratio is the right one to avoid that mortgage insurance, because that's not benefiting you in any way, shape, or form. So a very important element, probably number 3, right? Interest rate number 1, term number 2, loan to value number 3, and then next up are the other things to be thinking about. Cost, obviously, would be kind of next on that list. Closing costs. Any mortgage requires a cost. So make sure that you understand what the cost is and what the fees and how that's going to get paid, and be careful if they just simply, don't worry about the cost, we'll just roll it into the loan. Well, that just means that you may be paying on that for a very long period of time. So make sure you understand the costs. Similarly, you want to know whether there is a prepayment penalty or not. Now, oftentimes you won't see that as often as perhaps you might have in the past, but that's still an important question to ask is, well, if I decide to repay this in its entirety, and generally people don't just repay their mortgages. Oftentimes what happens is they refinance into something else. Well, that still counts as a prepayment or as an early payoff of that mortgage, even though you didn't write a check and pay off the entire balance of the mortgage. The reality is that by doing a refinance, that's effectively what happens. So that's where you could see that prepayment penalty sort of rear its head and cost people money. So that's one of those things that you also want to make sure that you can ask and understand. And then lastly is what the escrow is going to be on that mortgage. Many times banks will require you to escrow your homeowner's insurance, your real estate taxes in as part of the payment of the mortgage. Why do they do that? Well, they don't trust you at the end of the day. That's why they're making you pay it, because they want to make sure that your house is insured should anything happen to it, tornado comes through, or hurricane or whatever. And they also want to make sure that there aren't any tax liens on it, because all of that would affect their ability to go and sell your house in the event of a foreclosure. So the notion of escrowing is not really anything that sort of helps you. I mean, it may help with some discipline, but we would hope that you would be disciplined enough to be putting money away for your real estate taxes and insurance payments along the way and not have that big surprise to you because it is due every year. But the thing that kind of always bugs me about an escrow payment is just how paternalistic it is, right? I mean, the whole concept of an escrow is that the bank does not trust you enough that you're going to actually go and pay your homeowner's insurance and you're going to actually go and pay your real estate taxes. I just don't like that from a paternalistic point of view. I don't need the bank, babysitting me, and I don't think you need the bank babysitting you either. So ask those questions. Sometimes you can't avoid it. The bank is, digs its heels in on the escrow thing, but it's important to ask that and be aware of that, because then that becomes part of your payment each and every month, and there's no way you're not going to be able to get out of that. Meanwhile, if you didn't have to escrow, you have a little bit more flexibility, but of course, you've got to do the right stuff, right? I mean, you've got to save money each and every month to make sure that your insurance and real estate taxes are going to be covered when that bill comes due. So those are the 6 things to be aware of about a mortgage. Number 1, of course, interest rate, but also term. How long is that loan for? Number 3, loan to value. How much you borrowing versus the value of the house? Number 4, what's the cost of doing all of this? Number 5, is there a prepayment penalty that comes with that mortgage? And then, of course, number 6 is the escrow. So some of those those are the 6 questions you should be asking, or the 6 key pieces of information that you should have if you are in the process of doing a refinance or getting a mortgage for the first time. So hopefully that all made sense to our listeners out there. We're going to take a break. When we get back from the break, we'll go into our last segment. We'll talk about interest rates. Fed's about ready to meet in another couple of weeks. This continuing conversation of negative interest rates, what it all means, and the impact that it will have on your investments when we get back from these messages here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio WFLA Orlando. Howdy, friends. We are back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando. As is always the case, if you missed any part of the program, we will put it up on all the various social media networks and the like. Tomorrow, the audio version goes up. So if you are interested in listening to it, it's on a variety of platforms. To find out your favorite platform and the direct connect to our station on that platform, just visit our website at nelsonfinancialplanning.com. That's nelsonfinancialplanning.com. Upper right-hand corner, you'll see a bunch of icons. Click on the one that's most familiar to you, and you'll get redirected to the program on an audio format. Or you can visit us on our YouTube channel. That's Nelson Financial Planning. So if you search that in YouTube, you'll come to our YouTube channel. On the YouTube channel, you'll see a full video of the program itself. Cameras set up here and taping the program as we do the program. So if you're interested in kind of looking at videos and seeing how much I actually talk with my hands, which I do a lot, then you can see that on the YouTube channel as well. We also do a quick little synopsis of what the program was all about. We'll put that up on Facebook. So those are the other ways that you can stay in touch with us if you missed any part of the show, or simply are in a church or what have you and don't get the opportunity to hear the show. There's a ton of other ways to get connected with us. So we look forward to you joining us on those other platforms as well. This part of the program, we thought we would spend a little bit of time talking about interest rates. We're going to continue to hear more of that, particularly over the course of the next couple of weeks. 2 weeks from now, the Federal Reserve meets again in what is widely expected to be another rate cut, another interest rate cut by the Federal Reserve, when it meets again in a couple of weeks. Now, to give a little bit of history on where the Federal Reserve rates have been, the real significant change obviously happened during the course of the financial crisis in 2008. By the end of 2008, the Federal Reserve had basically dropped its rates down to zero, and those rates stayed effectively there until the year 2015. So since 2015, between 2015 and 2018, there were no less than 9 increases in the federal funds rate. Each increase was 25 basis points, 0.25%. So a very slow, gradual rise back up. That flipped at the beginning of this year, and ultimately the Fed started to reduce rates. They've done it twice so far this year, expected to do it a third time here in a couple of weeks. But at the end of the day, may very well be done after this last one, particularly here in this country when you've got strong consumer spending data, when you've got such low unemployment, and you've got such strong corporate earnings. There really wouldn't be a need or traditional need to continue to cut interest rates for now. And so I think that's kind of where the Fed is they'll give it one more, but they may very well be pausing to kind of see how all of this shakes out. People forget that a interest rate move really doesn't filter into the economy instantaneous. It usually takes several months for that move to be felt in the economy. And so consequently, I think the Federal Reserve may do it one more time, one more cut, and then sort of pause and wait and see what happens. What's fascinating about this backdrop of these low interest rates is consumer behavior over that same period of time. So we have the Federal Reserve obviously responding to the 2008 financial crisis and cutting interest rates, okay, way down low, which means, though, that you're not really making anything at all on your savings. But the consumer, particularly here in America, apparently the message of being careful with your finances and not overspending and actually saving really is resonating. So over that same period of time, you have seen the savings rate in America double up to 8%, from 4% up to 8% during that same period of time. What's fascinating about that is that is a much higher percentage of assets that are just sitting, not making really hardly anything in terms of the interest rate or in terms of the actual return that folks are getting. But I think the financial crisis and the effect of that really did change behavior. And certainly when you look at the savings numbers, it's a pretty dramatic change in behavior. What's even more interesting is when you start to look at savings rates around the rest of the world. If you look at savings rates in a country like Japan, it's like 29%. If you look at a savings rate in a company like Germany, it's 25%. So much higher savings rates. And what that's doing is that's continues to put a lot of pressure on lower and lower interest rates, because as you continue to have that demand for that no risk proposition, that low risk government issued debt, then you continue to have a strong demand, which continues to hold those interest rates down at a much lower price, which is why we see so much of those interest rates now shifting negative, is because demand for those pushes price. Remember, price yield go in opposite directions on a bond, and so that continues to kind of push the interest rates down lower. And so when you look at this jump in savings rates, along with just still some degree of shell shock, if you will, post-2008, media does a good job at that, because every time the market goes down, they remind us that, oh, you could have 2008 all over again here. And I think that's a big component of this. The problem is that you've got a demographic problem as well that's layered on top of that. If you look at the working age population in Europe, in Japan, in China, you're looking at a reduction of anywhere from 0.5% to 1% in terms of the working age population. Couple that with some generous pension and high savings, like we've just talked about, and I think you have a continued demand for incredibly low interest rates. The important thing is that you don't go too far into that from an investment perspective. Because when you start to look at the equity premium that comes with owning stocks, you will find that you're doing much better on that side of the equation, because low interest rates have a tendency to hold up stock prices, which is why from an investment perspective, you don't want to be overloading on the bond side. You want to maintain that equity exposure, because those low interest rates are helping with those stock prices, particularly the equity premium that you get when you look at P/E ratios, things like that. So an important little commentary on interest rates and how that actually relates to stock prices as well. But we're out of time, so we'll have to cut that commentary short and get on out of here. This has been Dollars and Cents. This is Joel Garris of Nelson Financial Planning. And you've been listening to News Radio WFLA Orlando.